In January 2021, something happened in financial markets that was not supposed to be possible.
A community of retail investors on a Reddit forum called WallStreetBets organized, largely informally and without a central coordinator, to buy shares in a struggling video game retailer called GameStop. The hedge funds that had been betting massively on GameStop's decline suddenly found themselves trapped. The resulting short squeeze drove GameStop's stock from approximately $18 to a peak of $483 in less than 2 weeks. Melvin Capital, one of the primary short sellers, lost 53% of its total value in a single month. The episode was not just a market event. It was a cultural collision between retail investors and institutional power that had been building for years. To understand the squeeze, you need to understand the short position. Short selling is a bet that a stock's price will fall. A short seller borrows shares and immediately sells them, hoping to buy them back later at a lower price. If the price falls, they profit. If the price rises, they lose, theoretically without limit, because there is no ceiling on how high a stock can go.
GameStop had been one of the most heavily shorted stocks in the market. At its peak, the short interest in GameStop was approximately 140% of the total available float, meaning short sellers had borrowed and sold more shares than actually existed, a situation made possible through the mechanics of securities lending. This was not unusual in heavily shorted names. But it created a vulnerability. Keith Gill, known online as Roaring Kitty and by his Reddit handle DeepFuckingValue, had been publicly making the case for GameStop since 2019. His thesis was straightforward: the company was undervalued, the short position was too large, and a turnaround was possible under new board member Ryan Cohen, the founder of Chewy, who had taken a significant stake in GameStop. Gill had invested approximately $50,000 in GameStop options and shares. By the peak of the squeeze in late January 2021, his portfolio had grown to approximately $50 million. He posted screenshots of his gains to WallStreetBets. The community, hundreds of thousands of retail investors who felt excluded from and resentful of institutional financial power, treated those screenshots as a war banner. The critical moment came on January 28, 2021.
Robinhood, the brokerage app that had positioned itself as the democratizer of financial markets, with the tagline "Investing for Everyone," announced that it was halting purchases of GameStop and several other meme stocks. Users could still sell.
They could not buy.
The decision was made, Robinhood later explained, because of margin requirements imposed by its clearinghouse. Surging trading volume had triggered a $3 billion capital call that Robinhood could not immediately meet.
The technical explanation was real. The optics were catastrophic.
To retail investors who had been promised democratized access to markets, the decision looked exactly like what the most cynical among them had always suspected: when retail investors start winning, the system changes the rules.
Congressional hearings followed. Robinhood CEO Vlad Tenev testified before the House Financial Services Committee in February 2021. Keith Gill testified.
Executives from Citadel, the market-making firm that both provided liquidity and had close financial ties to Melvin Capital, testified. The hearings generated enormous noise and almost no regulatory change. The fundamental mechanics of the system, payment for order flow, clearinghouse capital requirements, short interest disclosure, remained largely intact. The people who were most harmed by the GameStop episode were, paradoxically, the retail investors who bought near the peak and held as the stock declined from $483 back toward its fundamental value.
The squeeze worked briefly and spectacularly. The aftermath was ordinary.
GameStop's stock, after its brief journey to $483, settled back into the teens and 20s, still elevated from its pre-squeeze levels, but nowhere near the heights of January. The company itself undertook a genuine operational pivot under Ryan Cohen, attempting to transform from a physical retail business into a technology company, with mixed early results.
But the GameStop episode's significance lies beyond any single stock's trajectory.
It demonstrated, for the first time at scale, that coordinated retail investors using social media and commission-free trading platforms could move markets in ways previously reserved for institutional players. The power dynamic between retail and institutional investors had shifted, not permanently, not completely, but measurably. Reddit versus Wall Street had,
for one extraordinary fortnight in January 2021, produced a genuinely unexpected result.